So here's a good example. So this was a May gas crack, RBOB gasoline long, the October gasoline long, October crude short. So this is typically what we did. We would do thousands of these spreads. So this would be the big wave, and you could literally make millions. And so, but even with a small retail trader, you do one contract, you still can make some big money. So here's, if you went long RBOB gasoline on the 6th of May, this is just marking it with a seasonality, and then you got out on the 28th of May. Over the last 15 years, it's been a winning trade, okay? No losers. The average profit, if you did one contract of this spread, was $1,378. It was making $60 a day over 23 days. So that was 100%. Here's another one. Here's live cattle. This is a spread between April, August. So you buy April live cattle, sell August live cattle. So this has been 100% winning trade. Here's another spread trade between soybean, different, this is a kind of timing spreads. Here's another winning trade. Here's soybeans. Soybeans are really good, 100%, 15 out of 15 years. Corn, live cattle. See, I mean, just potential, tremendous opportunity. Okay, so that's what it looked like for the crack spread. Now here's going into more detail on this crack spread. So this was going long October gasoline. This has been a winning trade, and short October crude, been a winning trade for the last 15 years. And so here's drilling down into every year. You can see that the average profit's been over $1,300. So you can see going back to 2008, this thing made 383. 1 year it made, if you just did it exactly, it made 3,376. So just very, very accurate. Now, again, but then when we use our momentum indicators, cycle indicators, we can avoid a lot of the potential equity drawdowns and things like that. So that's the combination that's really great for, you know, using seasonal stats as kind of the big anchor trend, and then we try to navigate into it using the model. So here's what it looked like, just a beautiful hard trend to the upside. Here's what it looks like on a seasonality continuation chart. Here's the spread right here. You see at the last 5 years, 15, 30 years, just a super strong trend to the upside. Here's what it looks like, you know, marking it with just going back with the crack spread. I pulled up the spread here for you to see here. You can see this would be the seasonality got in right here, right there. This was back on the 6th, and then it got out right here, okay? Now the system cycle model would have been out in here and out there, so a little bit better entry and exit on this one. So this would have been, if you did this crack spread, you would have made, I'll just go with the trading model. So we were looking at for this to move. So this would have been we would have been right here. And this is adjusted per barrel per spread. And this is what I'll teach you. So we would have been in, we would have bought gasoline at $19.87. The spread, when the spread was $19.87. That's the spread between RBOB gasoline, crude oil. So RBOB gasoline would be trading at $19.87 above one contract of crude oil. Okay, so that's the spread. And then the spread though went from 1987, and then with our model, we would have gotten out here. The seasonality got out here. So we would have been out right there, and that was at $21.95 per spread. So you can see the spread widen, right? From $21.95 from 1987. So that spread widened out by $2.08. That's per barrel, okay? That's per barrel, okay? Now per barrel, so when we look at one contract of the WTI or NASDAQ, not NASDAQ, but one contract of oil is equivalent to 1 barrel of oil is equivalent to 1,000 futures contracts. So this would be, your profit here would be 2,000 times 1,000. So your profit would have been $2,080. Okay, so if you did this, just a crack spread, just if you bought it right here, the spread at $18.97, you sold it right there at $21.95, you would have made $2,080. If you did the seasonal, where you just blindly got in on the seasonal entry right here, And out here, you would have ended up making 2,800. This one actually turned out a little bit better from the seasonality. But the point is, a lot of times you might have these drawdowns. So this really gives you that extra kind of benefit of the trade.